During moments like these, sometimes you may hear things that you've heard before. Sometimes you might learn things that are new. But more than anything, I think during times of market volatility, it is quite an emotional experience and it's an emotional time. And so sometimes that release valve, as we like to call it in the industry, is very important, where you can hear what's going on and you can sort of gain confidence that the folks overlooking your investments are cognizant of what's going on and are conscious and doing everything that they can. So with that, we wanted to just take an overview of what's going on so far this year. SubhanAllah, the last 3 months have definitely felt like 3 years for me. And I imagine it's very similar to folks all over the world. But with that, maybe we can give you guys some data points and some color to kind of guide the conversation a little bit. So we have a couple of slides just to sort of guide. And if we move on to the first one. So just a quick market overview, and you might look at the numbers on the right and say, wait a minute, that doesn't look like the volatility and the swings day to day are so vast and so broad that, we've updated this as of mid-month in April, and it's already sort of probably a little bit stale. So things are quite dynamic and moving quickly. But just to give you guys an overview, last year we were sort of in a bit of a Goldilocks scenario. Things were at all-time highs. The market was humming along and things seemed to be in good order. Obviously, a huge catalyst was the administration changing in the US presidency. And, we heard some of the promises on the campaign trail, but, more often than not, sometimes we had to sort of discount what was being said or accept other things and not really know, when the candidates meant what they were saying and when they were sort of just pandering. Well, it's fairly clear that the talks on the tariffs and the international trade wars were not just lip service. In fact, if you go back historically into the 80s, there's clear evidence that the President Trump feels very, very strongly that it's a way to, I guess, establish some sort of equity in trade partners. Um, Unfortunately, economics professors would strongly disagree. So, the trade wars and the tariffs, the subsequent pause, the subsequent exceptions, the news of um, the exemption on electronics only to be rebuffed. These things have only added to market uncertainty. So, as you could tell, year to date, essentially almost all asset classes have really struggled, but mainly the US equity market has struggled the most. This chart says 9.8%, but there've been periods and even recently it's been down as much as 15 to 20% before recovering a little bit. Um, Chinese equities also haven't been immune from this, as China has been the main target of these tariffs. And so those stocks have also sold off quite a bit. And it seems like we're devolving into a situation where the US is going tit for tat with China. The one thing I want to highlight, or actually the three things I want to highlight on the slide very quickly, is the global ex-US market is doing much, much better than the US stock market. And the reasons for that, and that sort of justifies the reasons we have not just US stocks in our portfolios. We're diversified globally across the US, Europe, Asia, Latin America, the GCC, and so on. And so this diversification, and a lot of times when the US market was doing really well, we had a lot of clients ask us, well, why don't we just hold all US stocks or the Max 7? These things are all up 20, 30, 40%. And the answer tends to come out during periods of duress like this, where we see that having exposure to other geographies is actually a huge, huge pro. And we'll come back to that point. The second thing I want to highlight is Sukuks. Sukuks are meant to be sort of a low risk, quote unquote, low return asset class, and they're exhibiting that type of behavior here. They're not going to be an asset class that's in the double digits, but for the more conservative allocations globally, they are holding still and they don't essentially fall as much as stocks fall, which is what they're designed to do. And the last thing I'll comment on here is, as you guys know, particularly folks that have the type of cultural weddings and celebrations that involve a ton of gold and jewelry. Gold prices are through the roof now, where we've sort of blown through the 3,000 level, $3,000 level, and they look to keep rising. We think this will probably continue, and we'll give some of our opinions on what we think is going to happen going forward. But we'll go to the next slide. So just to put this in some context, obviously this isn't everything. Since 2019, this is the third largest pullback that we've seen on the S&P 500. And, whereas before maybe it was a little bit unexpected, maybe there was sort of a culmination of a perfect storm. This is clearly just due to the trade wars and the tariffs being instated by the US administration. Um, it has caught everybody by surprise, even those that are in the administration. Obviously, Wall Street was a very big Wall Street and the tech sector were huge proponents of the Trump administration coming into the White House. But everyone's been hit a bit blindsided by this. Now, when managing investments, we try to keep the emotional element out of it, whether you like him or you don't like him. He's sort of in office, so we have to essentially try to figure out, well, what does this mean for our client assets and portfolios? Um, Now, unfortunately, if there was some sort of academic research that was backed and that would say that potentially this could help, we'd be a little bit more measured. But by and large, kind of the ethos and the philosophy backing these types of trade wars doesn't really have a ton of data to support their efficacy. And so, saying that we have a trade deficit with a country, meaning that we export from them more than we import from them, isn't necessarily a bad thing. So the economist Mohammed Al-Arian, if anybody follows him on LinkedIn, he put it into an analogy where he says he has a trade deficit with his barber. He pays his barber to cut his hair, but he has a surplus maybe in some other places where, people pay him to do things. And so these are just sort of a natural state of things. They don't necessarily mean a country is getting ripped off or getting a raw deal from their neighbors. Rather, it's just the nature of a globalized environment. Where it's really caught people off guard is the US has really kind of gone after some of its strongest allies, Canada, Europe, and not an ally, but China as well, one of its biggest competitors. So that's really the catalyst here behind this recent drawdown. So we'll go to the next slide. So this will kind of tell you what tariffs look like before and what they look like now. And if the chart on the right looks dramatic, it's because it is. We didn't really have kind of a history of tariffing strong trade partners that we export to and import from. But unfortunately, particularly on the China side, we're looking at 145%, which obviously will hurt both sides of the aisle. The punchline from economics class, if you've ever taken a course there, is that nobody really wins and you have a big dead weight loss. The administration's goals seem to be to move a lot of factories and jobs back to the US. But there's a couple of problems with that theory. A, factories take some time to build. There's not sort of a switch that you flip and just move jobs over to a country right away. And the second is the US labor market in some cases has really outgrown some of the manufacturing sector. And so I don't think the US is going to have, factories making iPhones unless you want iPhones to cost $3,000, $4,000 each. And so unfortunately it's a bit of a naive, misguided way to try to, grow jobs domestically. And a recent figure had cited that it only generated $500 million of revenue while wiping out a few trillion dollars of market cap, which just goes to show you that this has been a huge unforced error from the US. Go to the next slide. Sorry, we'll stay on the previous slide for a second. And so, you know, we have to kind of digest what's going on here. I think, in the beginning I mentioned reading between the lines on this administration, reading between the tea leaves. And so, if you look at his book, and now we have to delve into a bit of a behavioral exercise. If you dive into his book, kind of The Art of the Deal, President Trump, prides himself on being a master negotiator and and sort of doing that. So this is really just blueprint from his book of establishing a very extreme position and then kind of, moving back a little bit until you get to a place where you're in a better position than before. Unfortunately, I think that there's a couple things wrong with those assumptions, and I'll outline them here. One is this is one of the few sell-offs we've seen in history where the US dollar is also weakening. Usually, when the market's uncertain and there's some panic, people flock to US assets. The US has always been seen as a safe haven. We're at a bit of an inflection point. Some would call it similar to Nixon when he moved away from the gold standard, where other countries around the world are thinking maybe we're putting too many sort of eggs in in the US basket. Maybe we should be moving away from relying on the US both as a currency as well as a sort of a safe haven. So during this sell-off, we're also seeing the dollar weaken, which is an alarming break in historical correlations. Usually the dollar strengthens during sell-offs. The second thing is the longer this goes on, we think the more and more damage it does. If tariffs are going to be here to stay, even if it's for 12 months or 24 months, globally, people will restructure trade, shipping, trade partners. And once those lines are made, the friction between kind of undoing that is much, much, much higher. And so, we expect this to put us in recession. We expect, unemployment to go up, particularly in the US. We expect the rest of the world to fare a lot better than the US. And so that's kind of our view right now. The miracle bull scenario would be that the people around the president would tell him this is a really bad idea to undo it. You're betting on essentially ego, him to swallow his pride and kind of, capitulate on some of these stances, which I don't think he's shown sort of a willingness to do. So if they're here to stay, even for 12 to 18 to 24 months, I think the damage can really be done. So we expect, unemployment to tick up in the US. We expect the consumer to really be shaken. The Federal Reserve has usually been the backstop for the US. Whenever things got bad, the Federal Reserve would lower interest rates. But we're in a weird environment right now where inflation still isn't low. So by all indications, the Federal Reserve seems to want to just hold off on interest rate cuts, excuse me, until it's really, really necessary. So we would call that sort of the Powell put, the Fed put, and I think that the threshold for things getting bad in the US is a lot lower now. Things have to sort of move a lot more before the central banks will get involved. So we're in a very uncomfortable position here. And so it sounds like very doom and gloomy, right? Sort of client work 101 always kind of tells us, to sort of be optimistic and glass half full, but it's not just a sales tactic. And if we go to the last slide here, so on the last slide here, we've sort of ranked the recent sell-off at its worst, which was about 19-20%, relative to other historical drawdowns on the S&P 500, which is the main sort of index we use to measure market performance and market sentiment. So, if we put these in context, we can see that this kind of ranks, maybe top 10, top 12 all time. It's certainly not the largest. We saw bigger drawdowns during the '09 Great Financial Crisis, during '87, and then during COVID as well. But this gives you a sense of kind of where this lies. So in the moment, it might feel like, the world is falling apart, but it's always good to take a step back and take a look at things long term. The columns on the right are what I really want to draw your attention to. And with the exception of 1999, which you see at the bottom, the 1, 3, and 5 year returns after these types of drawdowns have not only been positive, they've been dramatically positive, meaning that the worst days in the market are usually followed by some of the sharpest increases in the market. And unless you're in it, you'll very likely miss those sort of rallies. And so we don't know where this one is going to end up, but we can say with a high degree of certainty that as we go 1, 3, 5 years, that the market more likely than not is going to be in a better place. And so we have to look past what's going on right now, and it's a bit difficult because it seems like end of the world syndrome, but long term, we have seen things like this before. There is political uncertainty. We don't know if there'll be a third term here, but by all measures, things should, by any historical measures, sort of shake out and mean revert. So this is where we're at right now. So, before we kind of open it up to questions, I want to kind of sum up a couple of things. There have been some bright spots. Fixed income and Sukuks have held in better. So if you see the big swings in your portfolios and you're like 10, 20% is a lot, then perhaps that risk profile isn't sort of suitable for you. If you're much more comfortable with sort of, 1 to 5% swings than 10 to 20% swings, it's something to talk about with one of the client advisors we have on the call. It might potentially be time for you to re-examine your time horizon. Maybe when you started with Wahed in 2019, you had 10 years, but maybe now you only have 3, 4, 5 years. And so that might merit a change in sort of your asset allocation and outlook. Nothing may have changed, and this might just be an emotional exercise. So even still, you might want to talk to your client advisor and just renew your intentions and renew your sort of outlook. This is long-term funds. It's not meant to be sort of a day trading tool. Another bright spot is, there are things that are working like gold. I mentioned Sukuk, but gold is working. We have it in portfolios exactly for moments like this when things go sideways, it sort of holds up and rallies to offset some of the losses. So even though the market is down, 10, 20% in some places, the portfolios we have for clients are down way less than that. And that's why we diversify into different asset classes. And you only really see their value during moments like this. And then the last thing we'll talk about is that, across the portfolios, whether you're in Malaysia, whether you're being serviced out of the UAE, the US, the UK, we don't only invest in one country and one region. Yes, the US has been sort of leading the pack in terms of innovation, pioneering kind of different technologies that are coming out from AI and cloud services and whatnot. But we invest in an array of global services and stocks, and it's because we need diversification in portfolios. We want access to different geographies, different sectors, different points in the economic cycle. And so, this is just the beginning of a 4, maybe potentially 8-year term. And so the market will probably eventually shake off, this type of worry long term. But in the moment, we have an allocation to non-US equities. And so we also have the ability from Wahed for you to sort of implement your own views. You might have a view that you want to express. And so for many of the regions, and again, talk to your financial advisors here, but you might want to dial that non-US allocation up quite a bit. And so if that is your view in the regions which we can implement this, then I think it's something that's definitely worth a conversation. We think kind of our portfolios are optimized and we're going to revisit those. But, if you have a view that, listen, I want non-US stocks to comprise a much higher percent of my portfolio, in many of our regions, you have the ability to express that. And so, we do what we think is best, but we also have clients that are very smart, that are very hands-on, that kind of want to get ahead of this. And so our advice to you to sum up would be sort of stay invested. I would say try to take the emotions out of it. A lot of people say that, if house prices in their city or car prices in their city drop 20%, that they would be buying hand over fist. Well, now is a testament that it's a lot harder to do when you're in the moment. So having that recurring balance, recurring deposit set up in your account kind of takes the emotion out of it. But also, if you do have some cash that you're sitting on waiting for an opportunity, things are meaningfully cheaper right now. And so, the one question I see in the Q&A is, do we expect a recession? Uh, Probably, but the markets tend to sort of bottom 6 to 12 months before an actual recession. And so if you're waiting for the actual recession to come in and buy, chances are things have already rallied quite a bit before then. So you might have actually missed the kind of the upside there. So I'll pause. That was a sort of a lot of content to take in. Anything that sort of resonated, you vehemently disagree with on the client advisor side, or any comments in the chat or questions that you think we should address?
Jazakallah khair, Samim. So some really great commentary coming in through the chat box as well as the Q&A. I think there's a couple of common questions coming up. Obviously, you've talked about are we in a recession or not? Apart from you pulling out your crystal ball, it's going to be quite difficult, but everything points towards that at the moment. We've got a great question here, and this is for new investors. And given the somewhat gloomy perspectives, is it an appropriate time to enter the market and invest now?
Yeah, I think that a lot of folks that we all come from, I would say, predominantly sort of Middle Eastern, South Asian, East Asian cultures, which our elders tell us pound the table on real estate, which is definitely kind of a useful asset class. And the markets seem like a bit of a black box and people are unfamiliar. So I'll say yes, but I'll caveat it. If by being invested you mean opening up a brokerage account, in a Robinhood account, Trade 212 account, some sort of interactive brokers account, and buying what people are talking about on Wall Street bets, I would advise you not to do so. I think there's a right way to do this and there's a wrong way to do this. And I think that folks that try to day trade and do this long term independently, They might have a good month, they might have a good 6 months, they might even have a good year. But we're not concerned with how much money can you make in a year. We're concerned with you generationally accumulating wealth for expenses, passing them down to your children, and then growing your assets. So over the long term, that strategy just does not work. And so if you're new to the markets, think of the recent sell off as things just got cheaper by 20%. And they really did. If you were looking to buy some sort of car, you know, if the I know a lot of people in my family are obsessed with Toyotas because of the reliability. If the Camry fell 20% in price, I could guarantee you that folks would probably be buying that car hand over fist right now. If home prices in New York City, the Bay Area, central London, prime real estate markets around the world came down 25%, I could guarantee you people would be there to hold it. Not because they thought it would go up next year, but they know over the long run that they'd be okay. And I would carry the same analogy here. Things seem to be a bit of a sale now for good reason, but long term, we need to look past presidents will come and go, administrations will come and go. But as long as sort of, the rule of law is still there and the markets are still operating, I think we should be okay long term.
Jazakallah khair for that, Samim. That follows on nicely, I suppose, to this next question in terms of. So this is a double question, but they lead onto each other. So, do you believe that investing into Chinese stock market also to compensate for the loose US stock market, or vice versa?
Yeah, I think that right now the US and China seem to be in the crosshairs of this trade war. Every other country has sort of been deprioritized and exemptions have been announced for a lot of countries that haven't retaliated on US tariffs. So this really seems to be about China. Now, because it's about China, China is going to have to take action every time something happens. China's clearly a larger and larger part of the global economy. So I think that momentum will continue. But I would actually slightly modify your question. Maybe the best way to play this is to look at other regions, European regions, regions that maybe are going to be unaffected and are going to be able to sort of like, look back and benefit from this. If right now, if it's the United States versus the world, um, we obviously have a lot of folks that we're trying to, combat and figure out. The rest of the world only has one trade partner they need to worry about, which is the United States. And so they're much more adept at navigating that. And this might potentially be an opportunity for some of those other developed markets, Western Europe, some of the emerging markets, Australia, some of these markets to do well. Now we have exposure in our global ETFs to these markets. And so year to date, if the US equity ETFs are down about 15%, well, the global is only down 3. And in some cases, it's actually been up for large parts of the year. So that might actually be a better way to play that. It has some China, but it has no US. And so that might be a good way to play this if that is your view.
Jazakallah khair for that. So the next question that I've got is, well, this is a bit of a double-edged sword here. So this is probably more for the regional teams, depending on where the brother is. But one person has asked, do we have the option to hold cash in our Wahed accounts, um, so that we could put the money in to be able to then trade when there's further opportunities? So I'm going to go over to Eldin first of all, if that's possible, because I think the question has come from somebody based in the US, and then I'm going to open up to the other guys.
Yeah, in the US, we can technically do it. It has to be manually requested. So if you reach out to either myself or somebody from the support team and request it, then we can definitely leave it sitting in cash. We'll just liquidate your positions, leave it sitting in cash. And then when you want to re-enter the market or want to have your assets reinvested, you just let us know, and then we would automatically get that done for you, inshallah. So it's not a feature right now on the app that you can just go do it yourself. You would just manually request it, and then we'll take it from there.
Jazakallah khair, Eldin. Farhan, is that the same for the UAE and the international platform?
On the UAE side or international side, at the moment we don't have the functionality. I'd say the closest to that is opening up, let's say, a secondary portfolio which is entirely invested in sukuk, for example.
Mhm.
And we do have the functionality to do something called an internal transfer, so you can have several portfolios and move money from one to the other. I would just kind of caveat that even with the Sukuk portfolio, although the volatility or the price fluctuations are a lot lower or less pronounced than the others, there is still some volatility to be mindful of. So just, if that's one way you could tackle that, if you're interested, but just, kind of be careful that you might still see some volatility.
Yeah,
A third option also is, you could, if you see things are sort of at a level, you should really set up levels for yourself to say that if I see things down 20%, 25, 30%, regardless of how I feel emotionally, that I'm going to put more funds to use. So your option on cash, instead of sort of selling what you have right now, which might be in gains and triggering some sort of tax consequence, is to deposit new funds that don't have any basis on it. So that's one way to sort of take advantage of a sell-off, is sort of deposit new funds, long-term funds, obviously. But that's a way to sort of not trigger any sort of realized gains, and able to kind of take advantage. Because then when you're depositing, what our app does is it'll essentially purchase everything pro rata in your asset allocation, at these new prices.
yeah, exactly. And then here in the UK, we do have a cash only, very much like the US. It's an offline tool, so you will need to reach out to Fazil or myself to facilitate that. But that's possible. One of the key things I'd remind people is that everything that Samim has talked about, especially with this last slide here, the key thing, whilst we're in a drawdown position right now, you can see the calendar year ending, um, following this drawdown. So the key message that I want to portray here is that time in the market is better than trying to time the market. We will never ever be able to hit the bottom. We'll only know when the bottom is once it's happened. And with the markets the way they are, they're forward looking, whereas news headlines are backward looking. So please do bear that in mind. And if your investment timeline is long term, 5, 10, 15, 20 years, then in reality, whether you're going in today and it's the bottom, or you go in and next week it drops by another 5, 10%. Inshallah, it doesn't, but it can possibly happen. Then does it really matter? Is a question. Yes, it's going to hurt in the short term, but 5, 10, 15, 20 years from now, it'll be a blip, very much like some of these other significant drawdown periods have been, as you can see on your screens. So, so then there's another question just in terms of dollar cost averaging to manage the volatility and trying to buy the dip. But the US to UAE transfer fees, as well as the delays, how can we circumvent this? Is there any plans to improve this? Farhan, perhaps this is a question for you.
Yeah, sure. So yeah, it's a common issue we come across. For those based within the UAE itself, you have the functionality of depositing directly in dirhams in AED, and typically from what we've seen, you can circumvent the transfer fees that way. What will happen is we receive the funds in AED. On our side, the funds are automatically converted to USD on your behalf and then credited to your portfolio, and you don't face any international transaction fees. For those clients outside of the UAE, funding your UAE-based Wahed account, at the moment, I'd say the best option is probably to deposit less frequently but larger amounts. So if, for example, if you're planning to do $1,000 monthly, I'd probably suggest doing $3,000 quarterly, just so you bear those transaction fees once a quarter as opposed to every month. And yes, in the background, we are trying to work on solutions to that. But yeah, for now, I think that's the best thing to do.
Jazakallah khair. So there's a couple of questions here in terms of monetary policy, US dollar, and things like that. So what's the likelihood that the US dollar will stop being the currency of the world? And where do you see this moving to if you agree that this will happen?
Yeah, I think people have been talking about it for a long time with the BRICS nations and people moving away from the dollar. I don't think we're close, but I think that, and also the reason I'll tell you why we're not close and quick is just because of the transmission mechanism. When people say folks are buying or selling dollar, usually what that means is they're buying and selling US Treasuries. So it's not like they're buying piles of cash and sort of selling piles of cash. Rather, they're buying US denominated securities. And what is the most liquid and accessible? It's a US Treasury. So we are seeing, over the past few weeks, we have seen some flow data showing that Some Japanese banks and some Asian banks are selling their reserves of treasuries, which is why in this situation we've seen an interesting case of dollar weakening while things have sort of sold off, which is not the norm. Usually it's the opposite. So folks can certainly sell dollar assets. And if that leads to a rise in interest rates, now think about supply demand. If everyone's selling something, the price of that thing should go down. If the price of bonds go down, the yields go up. It's sort of the inverse relationship. But if the interest rates on the US Treasury curve start going up, it'll signal that people are selling vast amounts of US Treasuries. That's obviously a concern. And when this administration saw that, it was one thing that gave them pause and announced the pause is that's essentially their funding costs of financing the government activities, the military, and everything. So if those rates go really, really high and raise the cost of capital for the US government, you could probably expect them to sort of soften some language after that. Now, the hope is that it's not irreparable and irreversible, and we're not in a bad situation before then. I don't think it can happen right away, but as countries in Europe, particularly with the threat that exists with Russia, are seeing the US and saying this isn't really a reliable partner that has our interests in mind. We should probably fend for ourselves. And if that does happen, you'll see things like German bunds benefit and the euro sort of do a little bit better. So we'll see. I think we're seeing early signs of it, but for everyone to kind of move to a different reserve currency will take far more time. Let's see. But this is a weird situation where we are seeing some hesitancy against the US.
Jazakallah khair. There's some repeat questions coming up, so perhaps just to be a little bit more explicit here. So, do you advise taking money out of US stocks, putting it into global markets? Just wait, remain patient. Do we go for gold today? What's your suggestions here?
Yeah, I think a lot of our portfolios are sort of optimized to have everything US, global, gold, whatnot, even some real estate. And I think that everything, this is sort of the tricky nature of the markets is that you might have everything stacked against the US on paper, but you might have a firm in the US that has exemptions on tariffs that beats earnings by a lot. And so they sort of rally to the upside. So it's very difficult in a globalized economy to extrapolate a macro view to every single company within a country. There's always going to be winners and losers. And even from this current trade war, there are going to be companies in the US that do quite well. And, a lot of times those companies are in the funds that we hold. And so I would never advocate for eliminating exposure to a region because I think diversification is a good thing. But in many of the portfolios around the world, if we're 65-35 US, non-US, maybe it's time to start thinking about, narrowing that closer to 60-40, 55-45, 50-50, whatever that number is, retaining exposure on both sides, but essentially increasing the non-US portion of it. I don't think it's too late to sort of, invest in gold. There's indications that as long as uncertainty continues over the next few years, it should still be a nice tail risk hedge and a fear hedge. Um, and so we do have that in portfolios as well. So that's just some high level advice.
Jazakallah khair. Now, there's a few questions coming up, Samim, which I'm sure we've talked about internally quite a number of times. And that's to do with some of the constituents held within our funds. So fundamentally, the questions that we're asking is, there's a lot of our customers who are boycotting certain companies because of their complicit or activity in terms of supporting certain nations. And yet, we as Muslims, we're then investing into these kind of companies. As an institution, obviously, as Muslims, this hurts us as well. It pains us. But perhaps if you can just shed some light in terms of what our strategy is when it comes to this kind of stuff.
Yeah, absolutely. And I think it's good to take, as Islamic finance, as we're often dubbed, sort of an honest look in the mirror and just to kind of be transparent about where we're doing well and where we have some limitations. So, when something is Sharia compliant, It eliminates certain sectors. It eliminates companies that use a lot of leverage and interest and debt. Um, and what you're left with is sort of a sanitized list of companies that are quote unquote permissible. You forbid the evil, but then we also have enjoined the good. So I say this to say that even though we seem like we've been around for a while, the Islamic finance and investment space is still very nascent, I would say in its early stages. We've actually sort of appealed to some of the rule makers in the industry to sort of beef up and enhance their criteria for what makes something Sharia compliant beyond just filtering out screens and debt, sort of adding an additional layer um, of scrutiny around, okay, what is this company actually engaging in outside of it? So we are definitely trying to push the rule makers and the authorities and the scholars in the space to sort of enhance the criteria for what makes something permissible for us and getting us to the point where we're not only just omitting, but we're also just buying companies that are doing good. The second point of this is that, on the boycotts and stuff like that, I think that it's good to ask yourself, well, what do I want to accomplish and what do I want to achieve? And is this going to achieve it? And so, omitting a stock in your portfolio ostensibly doesn't really do anything to that stock. Now, from an introspective exercise of saying, I don't want to benefit from the returns of a stock that's engaging, that's a sound argument to say that, listen, from an introspective and just halal risk perspective, I don't want to sort of benefit from financial returns of those types of companies. That's a sound argument. But in terms of sort of, I guess, like submitting firms into some sort of submission on policy, it's not really the most effective way. Without going sort of in too much detail, we've seen that sort of a boycott on actual goods, consumer goods, is a much more powerful tool to do that. And so it might differ in your regions, legislation's different in your regions, but that's seen a lot more sort of backing and support, if I can say that. Sort of while the omissions on the security side is sort of certainly important, I think on the actual good side matters more. Moving some sales of a company 5% is massive, but omitting 5% of outstanding stocks doesn't really do much. So, everybody has their own reasons for wanting to do something. If it's an introspective exercise, that's one thing. I'll just wrap up by saying that, Alhamdulillah, we live in, a place and in a community that sometimes leans on a bit of moral absolutism, all or nothing. Is it good? Is it bad? And I think that the um, progression in our space is gradualism, is have we gotten something that got us from 0 to 1, and now how can we get something from what's 1 to 10? And so we're building with your support, we're continuing to build. And so, the more adoption, the more growth we have, hopefully we'll be able to release things. And we do have other products in the pipeline that are attempting to address some of these things more actively. We'll sort of release details as they become clearer and we're closer. But we've definitely heard kind of the feedback there, and that's been sort of the catalyst behind some of our product development efforts internally.
Jazakallah khair, Samim, for all of that insight. Now, I'm going to end with one a little bit light-hearted, perhaps. Depends on how you're going to respond to this. But so there's some questions coming in. In light of, just to give some context, in light of, global recessions, gold obviously has done well. Another asset class which a lot of people have talked up in recent years is crypto or Bitcoin. There's a couple of questions coming in. First of all, can we invest into crypto? It's probably not a fatwa question, but more just technical. As an institution, can we invest into crypto? And also, can we accept deposits from cryptocurrencies into the Wahed portfolios, perhaps from a diversification perspective?
Yeah, it's a question that we're getting more and more of. And, I'll share a couple of things. I'll say that there are definitely spaces within crypto that the scholarship and sort of the Muslim leaders have sort of been comfortable with. So there's certainly a segment of crypto that by Sharia standards is permissible, right? Probably not some of the speculative meme coins or whatever, but the ones that are actually like, infrastructure based and have the longevity, and you could probably guess which those are probably okay. to invest in from a Sharia standpoint. That's the Sharia standpoint. Now, from a Sharia standpoint, you might also be able to invest in a small cap or micro cap stock. The Sharia question doesn't really answer the volatility and suitability question because the volatility on some of these instruments can be extraordinarily high, sometimes akin to penny stocks. And so, even though you could invest into something by just nature of, you're allowed to, should you is a totally different question. And so that's the second piece is the suitability and the risk and the volatility. I would say crypto generally has way more volatility than any of our portfolios within our app and our platform. So doing that is very much a risk exercise where you ask yourself, should I do this? It's also an asset class that, the regulators are going back and forth on. And so we're obviously keeping a close eye on that. A lot of folks have asked us just in terms of a diversifier and a hedge to introduce it into portfolios, and we definitely understand those arguments. We don't want to get into a situation where they're in portfolios and sort of the tide turns the other way and we're told by regulators, well, this is a speculative asset class. Why were they in client portfolios and sort of a balance their growth or aggressive accounts. And so I would say that if you're interested in that space right now, it probably makes more sense to do it sort of in conjunction with your Wahed account, and your Wahed account being your main investment portfolio, and then using a very small sleeve to invest in one-off ideas like that. Currently, you don't have the ability to do it in-app. I think all deposits are sort of converted to fiat before they're invested in our portfolios. So that's the short answer. Hopefully, it doesn't sound like a cop-out, but that's the honest answer and why we haven't jumped on it so quick because at some level, we have to also think about suitability, risk, what makes sense, and not just putting things into portfolios that may or may not do well, but also have a high volatility that clients will sort of sometimes be whipsawed by.
Jazakallah khair for that, Samim. I found it really, really useful, interesting, and insightful in terms of all the content that you've gone through from giving context, but also some insight into how a strategy moves forward in light of market volatility and things like that. And inshallah, everybody who's attended has found it beneficial as well. We will continue to take questions from yourselves. Please do reach out to us. We have put our respective contact details in the chat box. So please do reach out to us. Obviously, we have our support teams as well that you can reach out to within the app as well. But yeah, if you want to speak to any one of us directly with regards to deposit issues or depositing strategy, all of that kind of stuff, we're all here on hand. And alhamdulillah, you've seen some of the comments from actual customers in terms of what team members have been able to do for them in terms of support and things like that. So please don't be afraid to reach out to us. We are all accessible, and we're more than happy to talk through your concerns, but also your long-term objectives here. Once again, I want to just say thank you to Samim and the rest of the global team who have joined. Jazakallah.
One comment, Abul, if I can just end off on this, is
Always.
that chances are, we've now grown to over a few 100,000 clients globally, alhamdulillah. And we were at a place, when we started where we didn't have anybody. So we're humbled and we appreciate sort of the confidence you have in us having like amana and guardianship over your assets. Chances are, if you're with Wahed, you were probably an early adopter, and there are probably four, five, six folks in your family that don't sort of currently use any asset management platform and are just sitting in cash. We have very, very low minimums because this is not meant to be an app just for the affluent. It's meant for be somebody who's sort of low income and just barely getting by, someone who's a business owner, someone who's super affluent. We're there for everyone. And so our ask of you is that if you've been with us long term, there's a high probability that you've benefited from some good return profiles and done well and grown your assets. And if that's the case, I think that it's probably responsibility is a strong word, but I do think you have a responsibility, or at least just to convey that to folks in your circle that may not be doing that. We entered an environment where high inflation is really wearing down people's purchasing power. And so I think a lot of folks in our community, our own families, are probably at a disservice and not having their investment accounts and stuff like their retirement accounts set up. And it's easy to ignore when you're young, but when you're older and you don't really have a safety net, it becomes a lot more of a drastic conversation. So if that's the case, I would sort of do a financial checkup with people in your home, in your immediate circle, in your sphere of influence. And if they are folks that haven't adopted or should, obviously we've included the contact information of all of our advisors in the chat. And so referrals are the best source of business for us because they're coming from our clients in our community. And so we would encourage everybody that was able to join on this call, if you have one or two referrals, you can keep us busy for quite a few weeks, and that can go on and on and on, inshallah. So jazakallah khair. We hope wherever you are, you're well. And may God keep us successful and keep you successful and help us weather the turmoil and the volatility, whether it's in the market, whether it's geopolitically. And inshallah, we will see you guys on a future webinar. Jazakallah
Just
khair.
very quickly on the referrals. I can't speak for all the markets, but don't forget to use your own personalized referral codes as well, so you can take advantage of those, and so you and your referee can benefit monetarily as well, inshallah.
Absolutely. Absolutely. Jazakallah khair, everybody. Assalamu alaikum wa rahmatullah.
Assalamu alaikum wa rahmatullahi wa barakatuh.